How payment processing companies make money on every click. Every time you buy something online, a small and largely invisible financial event takes place. You click a button, you enter a card number, you hit confirm. In the next 2 to 3 seconds, your purchase is approved or declined, and the merchant receives confirmation that they will be paid. What you do not see is the network of companies that participated in that transaction, each of whom took a fraction of a percent of your money before it arrived at the merchant's bank account. The payment processing industry. This is the payment processing industry, and it is one of the most structurally interesting businesses in the world, not because of any single company within it, but because of how the economics work at the infrastructure level. Today, we are going to walk through the full payment processing stack, explain exactly who makes money, how much, and why the model is so durable. Section 1. The transaction everyone ignores. Most people think of a payment as a simple two-party event. You pay a merchant. The merchant receives the money. The reality involves, at minimum, 4 distinct parties and often more. The 4 core parties. 1. The cardholder. 2. The merchant. 3. The issuing bank. 4. The acquiring bank. Sitting between the issuing bank and the acquiring bank is the card network, Visa, MasterCard, American Express, or Discover. And sitting between the merchant and the acquiring bank is often a payment processor or a payment gateway. What happens when you click Purchase? Your card information is sent from the merchant's website to the payment gateway, which encrypts and forwards it. The gateway sends the transaction details to the payment processor. The processor routes the request through the card network to the issuing bank. The issuing bank checks whether you have available credit or funds, whether the transaction looks legitimate, and whether anything about the transaction triggers a fraud flag. The issuing bank then sends back an approval or a decline through the same chain in reverse. Authorization completes in under 3 seconds. If approved, the merchant receives confirmation and ships the goods or delivers the service. The actual money movement, the settlement, typically happens within 1 to 2 business days. This is the infrastructure that processes tens of trillions of dollars in transactions every year globally, and every node in that chain is compensated for its role. Section 2. The fee structure. Now let's get into the money. The merchant discount rate. The total fee charged on a card transaction is called the merchant discount rate. It is the percentage of the transaction value that the merchant pays in order to accept the card. For most consumer credit card transactions in the United States, this rate falls somewhere between 1.5% and 3.5% of the transaction value. That fee is divided among 3 parties. Party 1, the issuing bank, interchange fee. The first and largest share goes to the issuing bank in the form of the interchange fee. This is set by the card network and represents compensation to the issuing bank for credit risk and rewards funding. Interchange typically represents about 70 to 80% of the total merchant discount rate. Party 2, the card network, assessment fee. The second share goes to the card network in the form of network assessment fees. These are typically in the range of 0.1 to 0.15% of the transaction. They are charged per transaction and represent payment for use of the network's infrastructure, brand, and global acceptance framework. Party 3, the acquirer or processor, acquirer markup. The third share goes to the acquirer or the payment processor. This represents compensation for the technology, risk management, banking relationships, and customer service provided to the merchant. This piece varies the most widely, from a few basis points for large enterprise merchants to 60 or 80 basis points for small businesses on flat-rate plans. Section 3. The card networks. The card networks, primarily Visa and MasterCard, occupy what is arguably the most elegant financial position in the entire ecosystem. They do not issue credit cards. They do not extend credit. They do not hold deposits. They carry almost no credit risk. What card networks actually do? What they do is operate the infrastructure through which authorization messages and settlement instructions travel. They maintain the rules of the network, and they charge a small fee on every transaction that flows across their rails. Visa and MasterCard net profit margins, historically above 50%. The business model is often compared to a toll road. The network builds and maintains the road. Everyone who wants to use it pays a toll. The toll is small on any individual transaction, but the volume of transactions globally is enormous and growing. The secular shift away from cash. Global card transaction volumes have grown consistently for decades, driven by the shift away from cash and checks and toward electronic payments. The card networks do not need to pick winners among merchants or consumers. They benefit from all of it equally. That structural neutrality, combined with the network effects of near-universal global acceptance, creates a position that is exceptionally difficult to disrupt. Section 4. The payment processors. Payment processors are the layer most people encounter when they interact with payment infrastructure as a business owner or a developer. They are not neutral infrastructure. They compete with each other. They are exposed to merchant attrition. They have to invest in technology, customer acquisition, and support. Large traditional processors. Fiserv acquired First Data. FIS operates WorldPay. Global Payments. These companies process hundreds of billions of dollars in transactions annually for millions of merchants. Next-generation processors. A second generation of payment processors emerged targeting small businesses and online commerce with simpler, transparent pricing. Stripe, 2.9% plus 30 cents per transaction. Square. PayPal. Stripe's model is particularly instructive. For most standard transactions, Stripe charges 2.9% plus 30 cents per transaction. This is significantly higher than what a large enterprise merchant would pay through a traditional processor. But for a small business or a startup developer, the value proposition is speed of integration, excellent documentation, and avoiding the complexity of traditional merchant account arrangements. Stripe captures the spread across the full merchant discount rate in a single flat-rate package. The processor layer is more competitive than the network layer, but companies that achieve scale in processing still generate substantial and recurring revenue, because merchants rarely switch processors once they are integrated. With Section 5, Issuers, Rewards, and the Credit Card Economy. The issuing bank receives the largest single share of each transaction through interchange, and it needs it. Interchange funds two expensive things. 1. Credit risk. When you make a purchase on a credit card, the issuing bank is effectively lending you money until your statement is due. Some percentage of borrowers will not pay. The bank absorbs those losses. Interchange is partial compensation for that risk. 2. Rewards programs. If you earn airline miles, cashback, hotel points, or any other reward for using your credit card, those rewards are funded almost entirely by interchange income. Premium rewards cards have higher interchange rates that compensate the issuing bank for the cost of those benefits. An important wealth transfer dynamic. Consumers who pay their credit card balance in full every month receive a subsidy funded by interchange. The merchant absorbs the interchange cost, bakes it into their prices, and every consumer who shops there pays those slightly higher prices, including consumers who pay with cash or debit. The credit card rewards go disproportionately to higher-income consumers who hold premium rewards cards. Interchange regulation. In the European Union, interchange fees are capped by regulation. In the United States, the Durbin Amendment capped debit interchange for large banks, but credit interchange remains largely unregulated. The issuing bank also makes money beyond interchange, through interest on revolving balances, annual card fees, foreign transaction fees, and late payment fees. Section 6. The Gateway and Emerging Infrastructure. The payment gateway is the technology interface that sits between a merchant's website or point-of-sale system and the payment processing network. It handles encryption, secure transmission of card data, formatting of authorization requests, and response handling. Gateway function is increasingly bundled. Traditional standalone gateway providers like Authorize.net processed enormous volumes of transactions for decades. Today, the gateway function is often bundled into the processor's offering. Emerging infrastructure layers. Buy now, pay later. Buy now, pay later providers, Affirm, Klarna, and Afterpay, insert themselves into the checkout flow and charge the merchant a higher fee than a standard credit card in exchange for offering installment payment options that increase conversion rates for higher ticket items. Digital wallets. Digital wallets. Apple Pay, Google Pay, PayPal add a layer above the card networks. When you pay with Apple Pay, a card stored in your wallet is still processed through Visa or MasterCard rails. Apple charges a small fee to the issuing bank for facilitating the transaction. Real-time payment networks. Real-time payment networks, the RTP network in the United States and similar infrastructure in other countries, represent a longer-term structural alternative to card-based payments. They allow account-to-account transfers that bypass card network rails entirely. Consumer adoption remains limited because real-time payments currently lack the fraud protections and rewards programs that make credit cards attractive to consumers. Section 7. Why investors find this industry durable. From an investment analysis perspective, the payment processing industry has several structural characteristics that long-term investors find attractive. 5 structural characteristics. 1. Volume sensitivity. Payment processing companies grow revenue as the total volume of electronic transactions grows, not just as their market share grows. As the global economy expands and as card payments penetrate markets that are still heavily cash-dependent, the total addressable volume grows without requiring competitive battles. 2. The take rate model. Payment companies earn a percentage of transaction value, not a fixed fee per transaction. This means that as the average transaction value increases due to inflation or economic growth, revenue grows automatically. 3. Switching costs. Merchants who have integrated a payment processor into their e-commerce platform, point-of-sale system, accounting software, and reporting workflows have substantial friction to switching. This creates natural customer retention. 4. Regulatory barriers. Becoming a payment processor or a card network participant requires navigating complex regulatory frameworks across every jurisdiction. Capital requirements, licensing, compliance with anti-money laundering rules, data security standards, these are genuine barriers that make it difficult for new entrants to compete at scale. 5. Network effects on acceptance. A card that is accepted everywhere is more valuable than a card accepted in some places. A network that includes more merchants is more valuable to cardholders, which makes it more attractive to issuers, which makes it more attractive to merchants. This dynamic reinforces the existing dominance of Visa and MasterCard in a way that is very difficult for new card networks to overcome. Conclusion. Every time someone clicks a payment button, a structured financial system activates in the background. In the time it takes to load the confirmation page, an authorization message has traveled through a gateway, to a processor, across a card network, to an issuing bank, and back. How the fee is divided. Issuing bank, 70 to 80% of total fee, credit risk and rewards. Card network, small consistent toll, infrastructure. Processor and acquirer, margin for technology and banking relationships. Merchant absorbs total cost and prices accordingly. Consumer completes the transaction in 3 seconds. What makes this industry remarkable from a financial analysis standpoint is not any single company within it, but the architecture of the system itself. It is a system designed to extract a small fraction of value from every commercial transaction, indefinitely, at scale, with compounding network effects and structural barriers to disruption. Invisible, essential, global. That kind of infrastructure tends to endure. Understanding how it works does not tell you what to buy or sell, but it gives you a foundation for evaluating companies within the sector with something more rigorous than a product impression. That is what financial literacy actually looks like in practice. This channel covers the mechanics of financial systems, business models, and capital allocation with the same structural depth we applied today. No predictions, no picks, no noise. Subscribe if that kind of analysis is useful to you. The most valuable thing in financial education is a durable mental model.